Okay, everyone, we're back, and we are now going to talk about. I said B2B payments is the hottest area of financial technology. It is not. Real estate tech is the hottest area of technology, and so why is that? Well, I think that first of all, real estate is the largest asset class. Just residential real estate is about 220 trillion in assets. So the entire value of the equity market at the end of last year was 83 trillion. So that's now down another, 15 or 20%. But I'd also say you could make a very strong case as more friction for investors and buyers and sellers than any other asset class. So what are some examples? Well, first of all, data is essential to competitive advantage in real estate investing, and yet and data is really not employed in a modern way in any of the real estate processes. And it's true at every single stage. So that's at price discovery, risk assessment, your due diligence, construction management, workflow automation, operational cost efficiency, insurance, debt structures, marketplaces, securing title, servicing, hedging, accessing liquidity, all of that. None of that is employing modern technology, not one single part. So it took a while, but now it's got lots and lots of interest. And I think that there's some really great innovations, and we're going to put them in, there's many different categories, but one is saying, all right, we're going to make ownership and investing easier. So that includes all three companies on this platform, but it's also creating new asset classes for investors. There's now suddenly an income stream that you can invest in, which is digital and digitally enabled. In many cases, though, involving very familiar assets. So that's what we're going to explore today. We have three terrific companies, and we'll start with Divvy, Edina Hefets, who is the very dynamic founder, opinionated, and luckily most of her opinions are right.
A good percentage.
And then Ribbon, which is Hui Gan, who's the co-founder and CTO. They do something similar, different approaches to it, both looking at single-family housing, but different approaches. So Divvy is making homeownership accessible through a unique rent-to-own model. And then what Ribbon does is enables people to buy a home without a down payment, or to bid on a home without a down payment, and then rent it to them, lease it to them to the extent that they don't get a mortgage. And then last is Skyline AI, and the CEO is Zipori. They are really creating a completely digital investment process for commercial, multifamily, residential investment assets, and they also created, therefore, a compelling investment product that goes along with that analytical approach that they've developed. So these are three very cool companies, and we're going to start with Adena and Hui, because you have different solutions to a similar problem. So why don't you start, Adena, with what is competitive, what is distinctive about the way you approach it, and why is that driving competitive advantage for you?
Yeah, so today, roughly around 60% of Americans can actually access a mortgage. If you look at mortgage decline rates and what's actually reported, it's closer to probably about 15%, but no one really applies for a mortgage if they don't have the down payment or they know that they have large amounts of student debt or something on their credit report that will make it so that they can access that. So today, there's no other alternative. You either rent or you own, and if you can own, you get a conventional mortgage. And those are your options. If you look at housing prices today, they've increased, call it 120% from where we were in the bottom of the recession. If you look at income growth at the same time, it just hasn't gone up, which basically means that houses are getting more expensive. You're expected to save more to have that same down payment. And yet, by the way, your income hasn't increased. More people are coming out of school with student debt and larger payments that they need to make. The average FICO that you need to actually access a mortgage is increasing. So the advantage that we offer consumers is we say, hey, we get it. Getting a mortgage is tough, and you don't want to put it off until you're 40 years old. So why don't we actually start by giving you kind of training wheels for a mortgage, which is we offer you the ability to pick out a home. We'll buy it for you. You rent it back the same you would with any other rental, but we also just let you buy equity in that house. And if you ever want to buy out the house entirely, you have that option and that right. And if you want to walk away, we will cash you out for your % ownership in the house. Mm-hmm. And so the advantage really is we're easier, quicker, simpler than a mortgage. and we allow people to kind of build into eventually having that down the road, but start today with something that's a little bit just easier to access.
Okay, Wei, what's your distinct competitive advantage?
And so we're big fans of Divvy. I think the customer base is actually quite different, right? Adena and her team are looking for folks who are looking to kind of build their path to homeownership, whereas Ruben actually goes after folks who actually are already ready to buy, right? And basically
or have a home. Many of them own a home.
Exactly, many
right?
of them own a home. And so who we call the move-up buyer, they're kind of stuck in the ultimate catch-22. Most American families can't afford 2 mortgages at the same time. And so what Ribbon does is we help them buy their new home, reserve it for them so that they have time to sell their prior home at the maximum value. And so we help move-up buyers basically buy their new home before they sell their current home. And we help first-time home buyers compete on a level playing field. They can actually get a mortgage, but their FHA loan actually shows up at the bottom of the stack when a seller is considering cash offers at the top, right? So we help eligible buyers. I'll say in terms of competitive advantage, the single biggest thing for us is that from day one we built a brand around realtors, right? And that has kind of come through for us in a way that I'll say we couldn't even have imagined on day one, because essentially the realtors face a lot of disruption, right? From the iBuyers, from the capital-enabled brokerages, whereas Ribbon has decided to, from day one, empower instead of disrupt this community, and have really been rewarded, right? And so realtors being one of our biggest channel partners, and they bring us their clients, we help their clients buy the home that they love.
Okay, so we're going to get to an important question for both of you in a second, which what type of investment vehicle does this create for investors when you have putting the capital up? But before, I'm going to let you noodle on that, but I'm going to ask Guy, describe your investment process and what type of investment that creates.
Sure. So Skyline AI is an artificial intelligence investment manager, and what that means is that you use our own proprietary AI technology, and we have multiple predictive models that helps us make better real estate investment decisions. So we are predicting things like asset values, rent, occupancy levels, and so on. And we partner with other real estate investment managers, and together we use that technology to source for deals, to build investment strategies, to vet those opportunities, and then acquire those assets, with the goal of generating an alpha and outperforming the market.
So, and how many people here do real estate investing, commercial real estate investing, or have? And how long does it take for you to evaluate a property? How long would you spend on something where you actually make the investment? Yeah. 1 or 2 months. And how long do you take to evaluate an investment?
At least the initial evaluation takes minutes, even less.
Yeah, it's someone who, when we looked at this company, they said the analytics they put together in seconds would have taken about a week for this very significant investors, portfolio analysis that they would have put together. So that's an example. I just want to put this in perspective. Now, what type of investment, though, are you creating? So you are buying houses, so that takes a lot of capital.
Yeah.
How do you finance that? And what do those investors get? What type of profile of return are they getting?
Yeah, so the single-family REIT market is pretty well known. There are large REITs, Invitation Homes, American Homes for Rent, Progress, and the way that they finance these homes is by taking the homes and deeding them into a warehouse facility, and then you put leverage on top of those homes. So you put debt on top of those homes. And those debt come from a bunch of different sources, but generally you get the senior piece of debt from a bank. So, for example, we work with Goldman Sachs, and they provide our senior leverage. And then you buy up basically the leverage levels that you want through a mezzanine debt provider. And so we have a mezzanine debt provider that comes in. This is a pretty active securitization market, so the pricing and the returns that a debt investor gets on this side of the market is fairly transparent and well.
But what about the appreciation with your share? How are you splitting that with the home, with your client, and how does that affect those returns that the investors get?
Yeah, so it doesn't really impact. The returns are a debt investment, and so we pay them a fixed interest rate absent what the appreciation is. That's our obligation. That's for our debt investors. Our customers on the other side, they're actually buying into the equity of the property with us, and they actually share in the equity appreciation. Today, the equity is held by Divvy and the customer, and the debt investor is kind of separate from that. So both us and the customers get the benefit of appreciation. We also get rent yield, and that's how we make money. That rent yield then goes to pay off our interest expense, and that's how the debt providers get their returns. And then any remainder comes up to Divvy. Today we make about 1.5 times, everyone looks at like net operating income, NOI, or the cap rate. per home than the best single-family REIT that's out there.
Okay. Wei, what do investors, how many times are you what's the basic financial model for investors that are financing the homes?
Yeah, that's a great question. So single-family homes, to what Edina said, are a known asset class for investors, right? Invitation homes and the like. I think what Ribbon, as a byproduct of our consumer product, had created was what's different about our capital product is that we not only have it secured by the home, producing rental yield, but it's actually pretty short duration, right? The average turn time for our homes, for the home buyers to buy it back from us, is basically 2 to 3 months. And so because of that, you have a kind of far more liquid asset than a very long-term rental, which changes things. Turns out in those 2 to 3 months, 90% plus of our home buyers actually buy the home back from us. But every single one of them is trying to do so. Turns out when you're trying to buy the house from us, you're probably the best renter in terms of taking care of everything in the house that you could possibly ask for. And those couple of things basically lead to a cap rate kind of 6-7% in some of the markets that we operate in. And so when we started out, we had debt facility right now that's with Goldman, similar to a warehouse line with some money from our own balance sheet. But we've gotten basically a surprising amount of interest from investors to own the whole thing, right? Because it's a kind of new asset for them. And so we're in the process of figuring that piece out.
Okay, so Guy, one of the things is real estate, the holding periods can be very long, which is what's attractive about them. How do you know your models are right? How do we know your models? How have you tested them? What can you say about that?
Yeah.
How do you know, but how do we know?
So actually, I can speak for hours on that topic and backtesting and testing in general. I think that it's important to understand that first, different predictive models require different testing, backtesting, and testing in general. And it's also important to understand how do you use those predictions in your decision making. We are backtesting and future testing regularly, and maybe just 2 examples trying to explain what I mean by that. So, for example, one of our predictive models is the value prediction. So, in our accuracy levels today are with our backtesting is better than, or when we started, we set the benchmark, and the benchmark was we took all the transactions and we looked at all the transactions that had some valuation or appraisal before they've been transacted, and we used that as a benchmark. And we're actually surprised that we were more accurate than the appraisal that assets got prior to being transacted. So when you backtest that, there are different stages of backtesting, but one is you take 80% of the data, you use that to train the models, and then 20% to backtest that. That's one thing. But then once you have a model, one of the things that we're doing is that every month we take the transactions from the previous months and we compare that to our value predictions. So this is already a future testing, and you see how accurate the models are when you compare them to real transaction that you predicted. So this is one example of a predictive model, and backtesting and future testing with some other models. One of the models that we use extensively is something we call soon to sale or soon to market. And what we're trying to do is predict the asset that will go on market. And this gives us an advantage and allow us to go after off-market opportunities. So in that case, again, similarly, there's a difference between backtesting that, but also now every month we look at, again, assets that have been transacted, and we're trying to see if we predicted that they will really go on market. And of course, in backtesting, there are different. Eventually, it's a blanket, right? If we can increase the accuracy by minimizing the universe of assets we're looking at. So going back to how you utilize that technology, in soon to sale, for example, we prefer to have smaller universe of assets, or looking only at the asset that we believe will outperform the market, and be more accurate on our ability to predict that they are actually transactable, then look at a larger universe, which we can't. Anyway, you can't really go after all the assets that you predict that will go on market. So in this case, take smaller universe and try to increase accuracy.
So I think this issue applies to all three of you because, as we said, it's a gigantic asset class, and it's really been regional in the way it's applied, or it's metropolitan areas in terms of the investors, the participants. So when you go to market, do you approach it in a regional approach, and then second, do you attack that ecosystem and try and completely disrupt the ecosystem, or do you collaborate and cooperate with the ecosystem? So we'll start with Edina.
Yeah, so we started out in Seattle. And so we started buying our first 3 homes in Seattle. And I don't know how many of you guys are from Seattle or know the area. I bid on exactly 3 homes and I was like, I'm out. This is enough for me. Mm-hmm. You'd bid on a house that was like $300,000 and it would go like $100,000 above list. And I was like, there is something fundamentally wrong with this market. And so we pulled back and we reassessed. And we actually scraped all of, and I shouldn't be saying this because I'm probably, but anyway, Paul's over there, and I'm like, I shouldn't tell anyone, but we scraped Zillow, Redfin, Trulia, every place we could scrape, and we pulled in every house that was listed for sale, and we said, what rent do we think we'll get on each individual house, and how much will that individual house appreciate? And then we clustered returns, and we saw where we thought in the U.S. was like a good place to invest.
Cleveland, Ohio.
And it came back Cleveland, Ohio, and I called up the
I knew it was going to be cool.
Well, but I called up the CEOs of like every major REIT, and I was like, hey, so this is weird, but like we're kind of thinking maybe Cleveland, and they were like, Adena, you know nothing about housing. Do not go to Cleveland, Ohio. We're telling you, just go to Atlanta. That's where everyone's buying single-family houses. Don't be an idiot. And so we went to Cleveland and Atlanta because I was like, well, if I'm wrong, at least we'll maybe have a good bet. And we started in those 2 markets. And what was really important was getting deep and penetrating those markets. So we work with realtors on the ground. We work with mortgage lenders and pick up their declines. We really get the name and the brand out there. And so if you drive through Cleveland or Atlanta, you will see billboards that say 60% of Americans cannot get a mortgage. We're here to help. Divvy Homes.
And do you collaborate with like realtor? I mean, what are the rest of the ecosystem? They hate you or like you?
We work well with everyone. We eat no one's lunch, which is like a nice place that I try to stay in, which is we buy houses from Open Door and Knock. We could be buying houses from Ribbon. We work well with realtors, so we always use a buying agent. So Keller Williams, Coldwell Banker, Remax, they're all our friends.
Your ecosystem friends.
That's what we attempt to do.
Okay, and Wei, what about you?
We are also ecosystem friends. We fundamentally believe that's the right approach. It's not only borne out in the data, but really kind of how well it's worked in terms of the distribution channel. I think for us, here's maybe a quick vignette. So Allen Tate is the biggest brokerage in the Carolinas, right, North and South Carolina, and so the way we expanded was quite organically in a sense, where we were in Charlotte first, right? We weren't in anywhere else in North Carolina, and Allen Tate basically said, okay, we need to use you, but we really need you in this area, this area, this area, this area as well. And we'll invite you to our conference. We'll bring you to our top 250 realtors. We will promote you every week to our agent base if you do this. And so part of it is basically following these regional brokerages that have tremendous reach, that really have a solidified brand and market to be able to expand without a ton of like on the ground.
You help them sell more homes.
Exactly.
Yeah. Okay. Now, Guy, is the ecosystem your friend? Blackstone hates you, right? They hope you fail miserably. But what does the rest of the community think?
Yeah. So we actually partner with large investment managers. One of the investors on the corporate level, but also a strategic partner of ours, is Reef of Deutsche Bank, large investment manager managing $700 billion, out of which $70 billion in real estate. And this is maybe one example of cooperation. So we partner with those groups that have foot on the ground and have vast experience, and together we form those investment vehicles that are utilizing the technology. And we are not we're not looking at specific markets. We're pretty wide. This is actually one of the advantages of our technology. You mentioned the time it takes for us to analyze or underwrite an opportunity, but we actually look at all the multifamily assets in the US that has more than 50 units, about 300,000 different properties all the time. So in every point in time, we have our opinion on what's the opportunity in each of those assets. So we actually say that we look at the market the other way around. While everyone are picking markets and then sub-markets to focus in, we're actually looking at the entire market. And eventually, of course...
What do you think of Cleveland?
I don't know if
You like
multifamily
Atlanta.
is
You like
there.
Atlanta, right? That is consistent with Edina.
We recently bought an asset in Roseville, Georgia, 400 unit asset. But we're not focused on evaluating markets, but we're focused on identifying the assets within the markets. So then, of course, the fundamentals needs to look good, but we first identified the asset itself, and then we look at the characteristics of the market that it lives in.
Okay, so let's talk about an important touchy subject, which is, so you all have elements of software in your business model. You have marketplace elements. You're using balance sheet, at least on an interim basis. So what is your model? How do you see that evolving? What's the mix, and what will that look like in the future?
You're saying how much technology, or what's the?
Well, you all have software.
Yeah.
That's part of it, but you're not a software company, and because you have a marketplace, and you also have a balance sheet. So all three of you have components of that. Where do you see it in a couple of years?
Yeah, so for us, tech underlies everything that we do. So REITs today have teams of 100 people in every single market that go out, their acquisitions team, they go pick out the houses they want, and they go buy them. Everything for us is done digitally, and I think that this is actually...
It's just you. You're the only employee.
It's actually not me. It's a software layer, but when I sat down with, again, the team at Invitation Homes, and we pulled up Atlanta, and I pulled up every house that's listed for sale, and you can show it on a map and say, here are the houses, they cluster, like here's where we're buying and here's where we're not buying. They're like, eyes popped out of their head, and they're like, how do you figure all that out? And you're like, well, use data science models to like geo-coordinate where there's condemned houses or foreclosed houses and where appreciation is, and then you just cluster and you figure out where you want to buy, and this is not technology they have. My fundamental view is to be valued as a tech company, your financials and fundamentals must reflect the fact that you actually are able to scale without adding bodies. And so for us, the number one metric we look at is homes per head, which essentially, if you look at Invitation Homes, they probably are the best people out there, and they can maybe get to like 50 homes per head. And us as a tech company, we need to get to hundreds of homes per head.
How much capital? That you still need capital for each purchase.
Completely. So capital is a core part of the ecosystem. I spend more time raising debt capital than I do equity capital, and that will probably persist and continue. And it's an important part of what my job is.
Okay. Guy, you have a point of view on this?
Yeah, so technology is, of course, the core of our company or our business, but the business model is an investment manager business model. So our revenue is coming from AUM fees and promote of real estate transaction that we execute. And it's actually, I only remember one meeting where people didn't ask us about licensing the technology. From the smaller investment managers to the largest. But we believe the potential for the company is much bigger as an investment manager. The total addressable market is huge, and we believe that this will allow us to create a more interesting and a larger business. And also our technology is focused on generating, what we're trying to do is generate an alpha. So licensing that creates a challenge. If you ask a few years down the road, the temptation is always there. So I don't know, can never know.
Yeah. So let's, and I'm going to wait. I'm sorry, but I want to ask one last question before we break. So, what percentage of the U.S. market will be using your product in 5 years?
Yeah.
So what do you think?
That's a great question. I think this. My answer to this basically also encapsulates the last question around like software or not, right? And so the way that Ribbon sees ourselves is I'm going to borrow a term from Pete Flint, who's on our board as a founder of Trulia, as a fintech-enabled marketplace, right? And so we believe in 5 years, so 2025, you're going to see 10% of the US market use a financial product like Ribbon, like Divvy, or like some of the iBuyers out there, right? But you will see 80% of the market using software to make the transaction seamless, right? And so while we started with the financial product, we've built a lot of software for realtors. They're not using just for the Ribbon transactions, but starting to use it for every single transaction. And that's where the true marketplace, the market network, if you will be one in the kind of the medium.
So we say it's 1 trillion or so of annual non-refi home purchases per year. You're saying what percentage?
10% will use the financial products. So
100
1.5
billion of would be some sort of intermediation, software type
Exactly.
of intermediation.
And then 80% of the transactions will use some kind of software layer.
All right, Adena, what would you say?
I actually think I'd flip the question on its head, which is like, you actually don't need to be that big to be a multi-billion-dollar company in this space. The largest player has 80,000 homes. That's less than 1% of the market. I think it's like 0.6% of single-family homes, and it has a $20 billion enterprise value company. And so for me, I think actually what's amazing about the business we're in is you have to believe that less than 1% of people, eligible households actually use our product to be a tens of billion-dollar company. And so
Okay, I'll buy that. All right, Guy, what do you say?
Yeah, so first, I hate predicting without data, but I think that, and we're meeting.
You're at a conference. This is what everyone does.
But I think, and we actually surprise how open real estate people are in adopting new technology. I think you mentioned Blackstone. They invest dozens of millions of dollars in advanced technology for the investment process. I believe that, I'm not sure if it will take 3 years, 5 years, or 10, but I think even the real estate people that not necessarily understand technology today understand that or believe that this will be changed fundamentally, and people that doesn't utilize technology will not be able, or the ones that doesn't utilize technology will not be able to compete with the ones that does utilize technology. So I think we'll see that more and more. We're proud to be market leaders today and pioneers, but I'm sure it will be more available in the next few years, and the majority of real estate investing will be utilizing advanced technology.
Okay, and with that, we are out of time, but hopefully all of you now are fired up about technology-enabled real estate investing. Thanks to our panel. Thanks to all of you.
Thank you very much.
Okay.
Everyone.
Should go out and buy a house.